The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalized advice tailored to your specific situation. And I think it's very key important to run your numbers before you actually go set up the strategy, because what you don't want is investing a lot amount of money into a asset and your running costs are so high, which is in some of the examples what we've seen for some of our customers, where they have been literally paying rates, water, strata, interest, insurance fees, agents fees. The running cost was so high that it just literally depleted the self-managed super fund balance. So it's important to do the numbers first before getting into any part of that kind of strategy.
Hello everyone, my name is Tamara and I am the practice manager at Ryker Capital. Welcome to another episode of The Wealth Guide, of course sponsored by Ryker Capital. I am on the sofa again with Senior Advisor Regmi. How are you today,
Tamara?
Ray?
I'm good. How are you?
Today, we're going to talk about something called self-managed super fund.
Very popular topic.
Very popular topic. People hear about it a lot. People inquire about it a lot. So I might just kind of ask you a few questions about it in general. And I know you have a really good client case study where you did recommend it and it worked well for the client. Maybe at a starting point. So what is the difference between your kind of standard super fund that you might get when you join an employer as an employee and a self-managed super fund?
Look, great question, Tamara. Look, obviously self-managed super fund have grown in popularity over the years, and it's estimated there's roughly around 24,000 self-managed super funds established every year, which is a significant amount of self-managed super fund created, if you like. So obviously, let's understand what a self-managed super fund is. It's just basically a private super fund, which is very different to your normal retail or your industry super funds. So essentially what you're doing as running a self-managed super fund, which is your own private super fund, you're putting on a trustee cap to go that you are running that self-managed super fund effectively. You're making all the investment, the financial decisions, and all the other associated structures that are going to be structured out within that self-managed super fund. So you're making those decisions on behalf of the super fund.
Okay, so that's significant. So you're a member of the super fund, which we all are now, but you also have that trustee hat on. So you've got to be, I guess, feel like you're capable, you have the time, you have the interest to do that?
Correct. And the effort obviously does require a bit of legal knowledge as well as the bit of tax knowledge, if you like. You can't have any more than 6 members. Now, it can be individual to a trustee or a corporate trustee. But yeah, I'm like, in any which case, you are responsible to manage, run and operate the fund.
So I would assume when people come to you going, I'm considering this, you do give them a really clear understanding of what it means to be a trustee and make sure they test it out and they really are willing and able and really understand what that means.
Absolutely. And whilst running a self-managed super fund can be very appealing to a lot of people, it is a considerable amount of work. So we do sort of and give them an understanding of what it actually required to run a self-managed super fund. Because there is quite a bit of nuances that you got to be aware of when you're sort of operating and running the self-managed super fund. It wouldn't be the same as what you have in a normal industry or a retail super fund.
But to your point too as well, they're ultimately responsible, but they can outsource with responsibility things like, I need an accountant to do the financial returns, which need to be done. So they don't have to do the financial returns.
Correct. So it's the taxing as well as the auditing side that needs to be independently done on the self-managed super fund. You still can outsource a lot of around the investing side as to how you want to invest the money. You need a bit of legal knowledge, so which means you need lawyers' help to sort of draft up what is the structure of the self-managed super fund looks like. But also you're going to then need a financial planner to sort of see if you can get help to go, what kind of investment decisions should I make with my self-managed super fund? So it can be quite costly, but all depending on the circumstances of why there is a self-managed super fund required.
That's a good segue, because I was going to ask, what is kind of a minimum balance in my superannuation that really I should get to before I kind of consider even getting a self-managed super fund because of that cost factor, right?
Look,
is that a loaded question?
It is very much a loaded question. Look, I think generally the starting balance of the super fund, self-managed super fund, is recommended around like $250,000 or perhaps a little bit more. But depending on what your future goals are in the super funds, and effectively if you're going to be making a large level of contributions in the super fund, you can start that at a minimum balance as well, but in the very rare case scenario. But you've got to make sure that there's viability in that self-managed super fund. If you're starting with a lower balance, it does attract significant amount of cost, which does deplete the balance of a self-managed super fund. So you got to be mindful of what balances. I think it's important to check those kind of goals and considerations with your advisor or an accountant before you sort of
consider it seriously.
Yeah, absolutely.
So let's segue into the case study. So I know you were talking about, and I'd love you to, of course, flesh it out, but I'll set the tone. So I believe it was a husband and wife. They're both medical practitioners.
Yep.
They're both self-employed.
Yeah.
And I think they're out in, I believe it was Westmead here in New South Wales. Fairly big leasing cost. They have to obviously have a practice, a physical practice where their clients can come to, and leasing a premises for their business is quite costly.
Yeah.
I believe they had quite a bit saved up in super, kind of closer to that 800,000 mark.
Exactly.
So quite substantial, way over that 200,000. And then so they came to you with, if we buy a property instead of leasing a property, can we do it in self-managed super fund?
You absolutely can. I think from their part of their structure, I think important part for them was to how do they reduce the leasing costs, but also I think in this consideration, how do they sort of help their company reduce their company taxes at the same time? So as a practice, their company or the medical practice was earning roughly around the $3 million mark. Not to mention that obviously they were paying out this large amount of leasing costs to another entity. So they had this significant amount of balance in the super fund, which was about $800,000. Consideration here was going, well, okay, let's look at the strategies which will help us not only on the leasing cost side, but also help you reduce some of your company tax. So the idea then sort of became that they were going to look to establish a self-managed super fund with their accountant's help. So we had to plan out a strategy to go, well, okay, what are you going to borrow? What does that cost look like as far as borrowing those that amount of money? So for them to have a practice in Westmead, I think their property they were looking at was roughly around the $1.6 million mark. So they already had $800,000 in super fund, and their normal super fund, which was quite a significant amount between them. So they only had to borrow about 50% of that balance, or perhaps we recommended a little bit more because you still need to have an additional amount of money sitting in the cash component to operate the running expenses of the self-managed super fund, because you got to counter in any kind of rates, water, strata, or any of the other expenses that might sort of come out of it. So they did end up borrowing about roughly $850,000, roughly. And effectively what happened was, once they sort of purchased the premises, they started their practice in that premises, and now the self-managed super fund was then paying rent to their company was paying rent to the self-managed super fund, and effectively thereby reducing company taxes. So it was rented out at the market rate as to what the market rate going for that Westmead property was, which would in turn help their company reduce their company taxes, but also the money was then received in the end at the self-managed super fund side.
Well, I think for me too, because effectively you're not worried about a property in your super and making sure you have a tenant and they're paying rent, because it's your company.
Exactly.
As
and
well.
You're the tenant.
You're the tenant. So it de-risks that element of having a property in self-managed super fund.
It does. However, there are key legal considerations that you do have to keep in mind. But again, I think individually, if you're looking at your own circumstances, like I mentioned before, I think you need to ensure that you're speaking to your financial planner or your accountant.
And you, I believe, also help somebody kind of project manage that as well, don't you? When they're considering, you'll need an accountant, you'll need a lawyer.
Exactly.
And help them make sure they know who the professional services are, in addition to what you do specifically as a financial advisor.
Us as financial advisors, we do have restrictions as to what we can give advice on. So we do lean on other professional advice, like an accountant, like a lawyer, or like perhaps a real estate agent who will then sort of help that meet that client's goals and needs. And effectively, it's a team of people that will help make sure that clients making the right decisions and they're setting into the right structures.
That's brilliant. So classic, I guess, if anybody is in that situation, they own their own business, they need a premises for their business. Maybe have a chat with somebody like you to really understand whether this is a viable option for them to get those advantages.
And I think it's very key important to run your numbers before you actually go set up the strategy, because what you don't want is investing a lot amount of money into a asset and your running costs are so high, which is in some of the examples what we've seen for some of our customers, where they have been literally paying rates, water, strata, interest, insurance fees, agents fees. The running cost was so high that it just literally depleted the self-managed super fund balance. So it's important to do the numbers first before getting into any part of that kind of strategy.
All right. No, you've convinced me. It's definitely complex. Definitely see a financial advisor like yourself who specializes in this kind of thing before you consider pulling the trigger on anything like that. Thank you very much, Ray. This is
no
very
problems at all,
insightful.
Tamara. Thank you.
Thanks.